Hi, Matt McAleer, Cumberland Advisors, September 22nd. You've heard me say it before, embrace the grind. The market is in a grind right now. Let's not try to outthink the market. We've gone with the thought process that very strong move through 4,200 in the S&P 500 was a significant move. From both a technical standpoint, from a trend standpoint, if you want to look at what led through that move from a relative strength standpoint, I'm going to be surprised. And by the way, I've been surprised many times in this business. But I'm going to be surprised if this pullback doesn't get met with some demand in that 4,200 to 4,300 area, at least initially. I know as soon as the market starts to sell off, you hear headlines and media types out there calling for the next, 20% drawdown, the next crash, and so on. I'm still in the camp that this 4,200 to 4,600 area is an area where we're trying to discover price going forward versus a realm of interest rates in the 4 to 5% area. Those 4 to 5% rates don't just get ignored. They have a direct impact on equities. They have a direct impact on capital allocation into the equity market. So as we saw the markets pull back really over the last 2 weeks, 3 weeks, you've seen a little soft bid into some of the defensive names, into the utilities, into the staples. They've outperformed a little bit over the last couple of weeks. The biggest problem I have there, they're expensive. They're in an expensive hiding spot. We used to camp out in Staples, camp out in McDonald's, camp out in Costco, camp out in Coca-Cola if the market was taking it on the chin or had started to roll over. I'm not so sure I want to camp out in those sectors, in those names, when I can get paid 5% risk-free. And if I'm thinking that, so are many other people thinking that. And that's what we're seeing. That's why even with some of the weakness, utilities, mild bid. Not like 10 years ago. If short-term rates were at 25 basis points, sure you'd go into utilities at a 3.5%, 4% dividend yield and play some defense. Now you have a choice. You can play defense in cash. That's what we're seeing. So we'll keep an eye on when that cash comes into the market. It's a bet like all trades are. Remember, different than an investment. We also discuss separate buckets, right? Your long-term money, whether that's retirement money, whether that's 5, 10, 20-year money, really shouldn't be affected by week-to-week interest rate moves, especially if you're adding to those accounts. Maybe it's an IRA, maybe it's a 401k. You can reliably remain aggressive there. If it's money with a time horizon, if it's money that can't be replaced, you're retired, can't go back to work to replace a 15, 20, 25% drawdown, then that 5% is an attractive allocation. So I think we have to work through that. Price in the equity market has to discover where it's comfortable versus these rates. And in terms of inflation, I'm still in the camp that we're peaking and starting to draw down. Hopefully, Fed has less to do going forward. But what the Fed does shouldn't affect what you and I do. We make the decision to trade, what to buy, what to sell. So be comfortable with your allocation, be comfortable with your strategy, and we'll take it from there. Let's go over to Moose, who's got a lot of fixed income news this week.
Hi, it's John Mousseau. I'm the CEO of Cumberland Advisors. This is the Bond Report, and it is Friday afternoon on September 22nd. This week, bonds kicked in the fanny. Basically 5-year, 10-year, 30-year Treasury bonds all up about 10 basis points in yield, 456, 443, 452 as you go out. 2-year bond was about a 508. That's up about 5 ticks on the week. All really on what we talked about last week, and that is the Fed's outlook. We saw the Fed pass on raising short-term interest rates, the Fed funds rate. We thought that would happen. We thought the important point was not only what they said, but how they said it. And they said it with a hawkish tone, that they're not done yet, that inflation remains stubborn, and that more hikes are most likely in the future. So bonds sold off a little bit. When you look at some of the other numbers, though, jobless claims, yes, less than expected. So the market took that as kind of a bearish sign for bonds. But you look at things like housing starts, down 11% month over month. You look at things like the Philadelphia Fed business outlook, down 13%. They're expecting that to be flat or off a little bit. That tells you that it's not all one way out there. What we are seeing is very good interest in bonds, kind of across the curve. Certainly municipal bonds, and they were off this week too, maybe actually a little more than treasuries. Why? Because this week you had a calendar, and we know dealers are cutting and running because it's hard to hedge stuff, so they price deals cheap, and that affects basically the curves that are put out. So what happens? Some of these muni deals, they're 10 times, 12 times, 15 times oversubscribed. So there's plenty of interest out there at these cheap levels. And we think that continues. We're here almost at the end of September. The fourth quarter is generally a pretty good one for bonds in general, most of the time. And that's because you head in, particularly on municipal bonds, you head into the big coupon and maturing rollover payments in the end of the year. That's December 1st and January 1st. And usually the buying starts ahead of that. So we don't see it being any different this year, and particularly at higher rates, we would expect to see plenty of demand on rollover. And probably a lot of that rollover doesn't seep into the equity markets, which, as we know, have been quite volatile. So that's it. We will see you next week and have some more data for you, but we think that bonds are certainly at attractive levels. Thanks a lot.
Enjoy the weekend. Thank you for watching, and we'll see you next Friday.